Okay, it is June 11th, and this is the Market Structure Edge live discussion. I'm Tim Quast. Thanks for being here. And market strategist Brian Wilson is here as well. And because I was just out, I'm going to hold that till the second half, and I'm going to hand the baton to Brian. And I'll just say, if you would just do two things: ask us a bunch of questions. We may or may not have the answers, and B, just mute yourself while Brian is speaking, if you would. Okay, Brian, over to you.
Thanks, Tim. Appreciate it. Good to see everyone again. We're really thankful to spend this time with you every week. Well, a couple of topics here today, and Tim and I will then cover the path ahead together. The first topic I wanted to touch on was something that I mentioned in my Monday morning note, and I think this is actually the actual chart that I used on the little image at the bottom. So the point here is what I was capturing: days in the market when the market had returns of 2% or worse, and then over the course, including this day, over the course of the next 4 days, what was the 5-day return in the market? And then same exercise, what was the 10-day return in the market? So just trying to get an idea, do dips get bought? Do things exacerbate? So if we look at the overall conclusion here, well, the conclusion is that over time, dips get bought. Average return on a 5-day basis is about -1%. So all of these moves were 2% or worse. It tells you over the next 4 days on average, you had gains of at least 1% in the market. In many cases, it was much more than that. You can see back in April, last April, the tariff tumult. You can see the increases after that. Worst weekly performance during the last April. Best weekly performance towards the end of that period, also during last April. If you look at the 10-day returns, it's basically the same premise. Everything is basically back to flat at that point. So on a 1-week basis, the market claws back at least 1%. On a 2-week basis, well, it's as if the event never happened. Best case, you can see it right here. Once again, towards the end of the tariff drama, market's up 7%. Worst performance on a 10-day basis at the beginning there of that tariff activity. So just wanted to give you an idea of what generally happens in the market over time. Of course, we had a 2% decline last Friday, and we'll see how it plays out this time. I was doing a little bit of activity yesterday related to SpaceX. So Tim and I both work for Modern IR as well as Market Structure Edge, and we wanted to just run an exercise. What are some of the expectations coming into the IPO itself? How might that be affecting the market ahead of time? What can we potentially look at afterwards? So I won't go through all these points, but I'll skim a couple of them. Expected market impact. Well, we're going to have short-term liquidity effects, and I think some of that has been hitting the broad market during the last week. And you can see it right here. Large IPOs often require investors to raise cash by selling other equities. We'll take a peek in a moment what some of those other equities might be. As we get into the IPO itself, you get a more volatile moves in stock price. It's probably going to be all over the map tomorrow. I think the expected pricing is 135, but a lot of movement afterwards. You'll get the fear of missing out dynamics. A lot of times that comes more from the retail crowd. Over time, we're going to have passive and index implications. I'll show you in just a moment what the considerations are right now for a sector perspective. And then a broader IPO pipeline catalyst. this could reinvigorate the IPO market and act as a catalyst for additional large-scale offerings. Right now, Anthropic is set for around October, OpenAI October to November, something like that. Those are tentative timelines, but those would be the next large ones in the pipeline. In terms of sector classification, the most likely landing spot is communication services. That's where, think of Starlink, it fits in with some of their telecom and digital infrastructure activities. And it's just the likely outcome based on revenue mix. You could potentially have industrials or tech as well, but what I've read is this is the most likely outcome. In terms of that sector classification, probably late June or early July, which is somewhat surprising, but it's not going to happen immediately. In terms of our data, and I'll show you what this looks like. And I think big tech has been used here as a source of cash coming into it. So if you look at the big tech setup, it's pretty weak. You see sentiment dropping. It's all the way down to 3.3. To me, that hints at the big liquid companies, people trimming money there first and foremost. One of the other ones that I think money is coming out of is, I believe, the communication services. These are the 10 largest communication services companies. Similar exercise to big tech. Look at the weakness there. So a lot of weakness coming into the IPO tomorrow. I'll circle back to that document that I showed you. I wanted to show you one thing from a big tech perspective. It's weak right now, and I did an exercise. What's the expected impact on the Magnificent Seven? And if we go through that, and I'll just take you to the summation, I think we've been seeing it here in the data recently. But short term, a slight to moderate negative, and as I described, basically being trimmed to fund the IPO participation. But as we then circle back to more of a medium term and long term perspective, well, from a medium term perspective, you're getting increased tech investment, AI and infrastructure demand, broader ecosystem growth. And then on the long term, the expectations are overwhelmingly positive. Right now, the schedule is for NASDAQ 100 inclusion, likely in early July. S&P products, Russell products later down the road. So the first one would be the NASDAQ 100. And in terms of the overall size, I might have shared this with you before, but this is the SPY, top 15 companies in the SPY. Right now, their market cap would fit right around in here. So roughly the size of Broadcom. They're going to come to market with a greater market cap than Meta and Tesla. One other thing to share, and then Tim, if you have any additional comments on SpaceX, feel free to. Just the topic of sentiment above 6. So what I'm referring to here, for those that are new to this, when sentiment rises above 6, the whole market just becomes a little bit stretched. And I'll show you over time what tends to happen. So you get these sentiment moves above 6 itself. Let's look at a recent one right through here, and the whole market just calms down for a period of time. Rises above 6, the whole market calms down. Rises above 6, the whole market calms down. And if you look back over the course of the last 7 years, that period above the red line, market average is about 50 basis points. If you do a measurement 2 weeks afterwards, it's essentially the same, about 60 basis points. So the market doesn't tend to collapse, but the gains just slow. Now, so far, we would say that recent activity has been an outlier. If we look at trading since we've gone above the red line, we've actually moved lower by about 4%. Now, maybe that measurement a week later, maybe it'll be back up. I don't know, but so far we would say that this has been a relative outlier. So Tim, that's it for me, and we can pick up that topic on the road ahead here in a couple minutes. Then.
Okay, thank you very much, Brian. So I'll make a couple of observations about SpaceX and in context. So, Chris Martin, you said, when do you expect to pick up SPCX in the data, in the edge data? I mean, you can go look at Cerebrus, however you pronounce it, Cerebrus. I think that's how the founder says it, right? So a play on cerebral. You will see that we have price and short volume data because we can get that from day one. But then to calculate rolling 5-day average inputs into our demand or market structure sentiment calculation takes about 20 days. And even then, it's not a great amount of data, right? It's which is the entire problem for these. It's the segue into SpaceX and Anesh. I think you asked about the impact of, say, the triple Q, the NASDAQ, which has, I don't know what the current number is. Let's call it 300,000 index products that they propagate. It's a big business for them. I mean, in the last quarter, the NASDAQ generated about 220 million quarterly revenue from their index products business alone. See, and then you got the listings business. So, they've got a horse in the race. They're listing SpaceX. So they're going to fall all over themselves trying to figure out how to make sure it's in the index. And they did. Realize that the amount of float in this offering is very small. I mean, relative to the expected valuation, and we have no idea, but if it's going to be, 1.8 trillion, the offering size at 75 billion is less than 5% of the float. Well, that won't get you in any legitimate I shouldn't say that, index. I mean, if we're honest about it, that isn't enough float. The whole point of index products, and it's what we do too, right? We're going to look at stuff that you can get out of. It's why we tend not to put much focus on small caps, which are 3% of market cap. You can't get into and out of them. Side point in that, as long as I don't lose my train of thought, is, it's not what something is worth. Is what happens when you go to sell it that matters. It's very much like your house. Your house, when you try to sell it, may be worth something else entirely. Warren Buffett made that observation. He said, whatever it was Apple they were referring to. And he said, well, yeah, for 100 shares of Apple, this is the price. But if you're trying to sell a lot of it, Apple is not priced at whatever price you see. And so this is the point for passives. They need something that will have, call it 2% tracking errors. You could extrapolate that out to in your own portfolio. If we calculate the standard deviation in the focus passive before this big move, when it told us to stop doing it, down 10%, we stop. So before that, 14.6% standard deviation in the components was pretty good. I mean, given that it's 10 or fewer components. But indexes need things that are going to hew to beta, not deliver alpha. Alpha is outperformance, beta is the market, and passives like BlackRock need the market. And so, as it pertains to the S&P 500 deciding not to make changes and permit early, but still, it's not that far off, permit SpaceX to be part of it, and NASDAQ is. What does that mean? Well, I'm not sure it means a whole lot. It clearly indexes want to include these things, just like they want to include Lumentum over CoStar. I mean, you want the stuff that everybody wants, even though you're trying to deliver beta, not alpha. Why? Because you're selling a product. All of these folks are selling a product to a consumer, and they want people to consume the product. What SpaceX might do, we might look at this in the ahead. I don't know what's going to happen. The market is very unwieldy at dealing with debris in the road. I use the analogy that the stock market is like a Ferrari, not in the sense that it's fast, it is, but in the sense that, when you're traveling at 200 miles per hour and you're low to the ground, you don't want to run into something. I had a friend in high school who had a 280Z. Remember those? I think it would have been a Datsun even then, Nissan. This was a long time ago. But that thing would do 160 miles an hour, and he hit a jackrabbit with it, and it totaled the car, right? This is the problem. When you have a car low to the ground like that, it's not good to encounter an obstacle. And in a sense, SpaceX is an obstacle. My expectation is that a lot of thought will have gone into this and that it will go off largely without a hitch. But there is certainly risk. I mentioned a case in point that, a corporate client of ours. And we do a lot of things for public companies to help them navigate this market. You should shorten your earnings release, report as close to the open as you can, because the volume in the opening auction might offset the bear bets against you. There are all kinds of things we do. So major consumer staples company adopted all these practices. They did them all. And over the last decade, they've not delivered much value. And year to date, before a change, some debris in the road, they were up 16%, way outperforming their peer group, which would include McDonald's. Walmart is their largest customer. And we were very happy with it. They made the low volatility daily trading ideas portfolio. That's difficult to do. Out of the thousands of stocks, there might only be a handful at a time that are liquid and have all the characteristics that one wants for almost the ideal stable vehicle. And they did all these things, and then they had a management change, and they have given it all back. All of the gains, all of the work. We just look at it and go, there's hitting the jackrabbit at 160 miles an hour. And so there is that risk. There is a risk of a rapid, unscheduled disassembly in stocks because of some debris in the market. The RUD, that cracks me up. So I had to use it today in the note, that there is that risk for no other reason than it presents some debris in a market that is heavily dependent on short-term predictability. And one other thing I would mention is the money. You have to think about the money. We used to have this conversation all the time with public companies. Think about the total addressable market. All public companies like to do is go cultivate sell-side coverage, analyst coverage, and then they go target institutional investors and attempt to enlist them as shareholders. But they don't stop to think whether the people they're targeting, are they net buyers or net sellers? That's a very important consideration. This is why we follow passive money, because the Morningstar data show that stock picking investors, call them active managers, sell $35 billion a month. They're net sellers, whereas BlackRock et al. Buy $75 billion a month. Every month they buy a SpaceX IPO. They've got that much capital to deploy because we all use them in our retirement accounts. We do too. The plan that Brian and I both participate in, it's principally passive. Well, so passive money, even if it's interested, like BlackRock, Fidelity is already an owner of SpaceX prior to the IPO. But they don't have the capacity to buy these things. I think that's the principal reason IPOs have generally failed. Even Cerebras, the most heralded IPO in a long while. Last time I looked at it, it's down 27% from its IPO price. Why would that happen? Well, because passives, just like us, when we're calculating data, need data. We have to know predictability, standard deviation, tracking errors, liquidity. What happens when I try to get in and out of this thing? How will it move? All of that data is very important, and it does not exist. And generally, IPOs struggle with those things because a lot of money is trying to get out. It's almost like a deal stop. So we tell, we have customers in like American Waterworks and Essential are both customers of ours in our corporate business because we help them understand what to expect when you go through a transaction. When you buy somebody else, you will be booted from indexes as statistical samples. Still own your stock, but you're not going to be the thing they use to track the benchmark, and from ETF baskets because you cause tracking errors. There are arbitrage bets. Now suddenly the stock may behave differently. All these things come into play, and they're things no one thinks about. All you ever hear about on CNBC is, what are the fundamental prospects? What's the market like? What are analyst expectations? All these things. Well, those are inputs, but they're only part of the picture. I mean, liquidity and volatility are the two profoundly vital data inputs for passive money. And that's why there's a risk here. So, it's why I say, well, just be very careful, even today, so I can't help but be a little bit cynical about, the decision in the Strait of Hormuz for the U.S. to suspend its operations against Iran because they don't want to jack up the market ahead of the SpaceX IPO. You're just going to have to stop. And so then the market bounces on that, but that's quantitative. And these things are disruptive to the market. I don't like to see it. I don't like on again, off again. Those are all inputs into how derivatives are priced, and it becomes very confusing. And so again, I would be cautionary here with regard to what happens. We don't know. Again, I do know the people well, at the exchanges. We buy data from the exchanges. We have a very good relationship with the exchanges. And they're smart people. They put a lot of work into trying to make these things work. But I can tell you that the data are a big deal. And I would be very careful here. That's all. Okay, so that covers a couple of my points. I wanted to weigh in on SpaceX. One other thing about the portfolios, the focused portfolios. So, when the model portfolio for those using it, to perform very well. And then we got to June and all of a sudden it didn't. And then it's down 10%. And no, it's not, we don't give advice. We just run data. But, our good rule of thumb is if the portfolio is down 10%, you just stop until the data are performing again. And it hasn't started performing. I mean, we've given back 35% of the gains, still up 36 or 7%, but it was up 56%. And we cannot find a model that will perform right now. And we're running them all the time. I mean, we have looked at every combo to try to figure out, is there anything that merits use at the moment, and we cannot come up with it. Well, then everybody else must be running into the same issue, right? That's what tells you when you should just be patient, and you can be fooled by the moment to the moment. You can be fooled by fundamentals. Everybody will say, for instance, look at the fundamentals, look at the expectation for earnings in the S&P 500. I know. Look at the earnings in the chip group. Yes, I get all of that. I could make a great case for tulip bulbs. There's nothing wrong with tulip bulbs. There wasn't anything wrong with tulip bulbs in 1637, except that the supply of Dutch florins had increased dramatically. And so it has nothing to do with the fundamentals of the business. It has to do with the data and demand and supply. And right at the moment, this is a dicey period. I will share my screen and just highlight one thing in particular. There are all kinds of things one could talk about. And look, none of us know what's going to happen. I mean, I feel very confident in what our data enable us to see. It's not the only way. It is a way. I think it is a superior way to think about the market because it does reflect the mechanics, the behaviors, the regulations of the market. But I would note this, that if you looked at this, and then you looked at this, they're very similar. They're not going to be exactly precisely the same. Behaviors change all the time. We're just looking for general central tendencies. There was a steep decline generally. There was, a little bump at in the early part of February. But I look at that and say, well, all I know is it could go either direction, right? There was a lot of volatility here. It's interesting that if you look at where the price was, whatever happens today, where the price closed yesterday did remove all of the outlier performance of the market that we warned about. As Brian pointed out, generally when broad sentiment is topped here and here, the market goes up 0.5%, 60 basis points. Instead, it went up like 10%, or whatever the number is. It's not quite, but you follow me, right? So now we gave all of that back. I mean, it's kind of fascinating when you think about it, that all of the outperformance relative to the mean went away. And here we are right at where the market was in February from a supply side. Supply has played the vital role in how the market has behaved. And so, when I say all these things simply to I hope help us to make well-informed decisions, because there are a lot of voices in our ears. We're like which ties into Jay Woods. I was in, and we'll wrap up here pretty quickly. We were in Chicago. Now I know Josh Brown. I can't, not well, but I trade emails with him on occasion. I've been on a panel with him. Don't know Jay Woods, but they both write for CNBC Pro. Clearly, they were very smart, seasoned veterans of the market, and I thought he did a great job. I mean, he had the audience for the whole time. It was a general session, and there are several hundred of us in the audience, and I thought he did a great, simple presentation of how the market generally works. He's a technician. I make fun of technicians, as you know. I'm kind of more like Julian Robertson would say that, technicals are hocus pocus, mumbo jumbo BS. But look, he's, built a great career with them. He talked about the long separation of the semiconductor crowd from their 200-day moving averages. And look, it can go on and on. I looked at the numbers and went, well, it's been going on for 18 months that they've been above their 200-day moving averages. Is that helpful? I mean, how do I know whether I should, if they're over their 200-day moving average, I should probably sell them, except they just keep going up. And, if you look at our data, let's just take our most owned stock in the focused portfolio, which would be Taiwan Semiconductor, noses out Lam Research as the leader. I could look at this and say, well, those are not moving the right direction, right? It just tells you I'm not really worried unless this drops below 5, which it hasn't. You could keep it in a long-term portfolio. But notice the supply side's rising and demand's falling. That to me is much more precise. That's a better indicator that the conditions are changing. That at this point, they don't tell us that it's anything to be concerned about, but it could become. And so I just think our market structure data, which encompass all of the inputs, everybody's motivation, whether it's fundamental, quantitative, technical, speculative, whatever it is, it will show up in demand and supply. And I think that's, to me, biased, that's helpful. Okay, so that basically covers what I wanted to cover. So I'll stop sharing and say, open the floor. If there's any comment, question, observation, let's have it. Anesh, let's see. IPO. Okay, Anesh says, and weigh in. So yeah, I agree with you, Anesh. So Anesh says IPO is an exit for insiders. I call them the initial public exit. They're exiting the private market is what I call it. I think it's a very difficult thing. Did you hear Philippe Coutu? I forget the name of his fund, but he's been very successful. And long ago, when I was young and tight-skinned, and he was beginning, he was a shareholder of the telecom for which I was the head of investor relations, and I sat in his office a couple of times, and I thought his French accent was hard to understand, but he's a big deal now. And he said passives have wrecked the IPO market. He had just had dinner the night before. He said, I saw it yesterday on CNBC with Larry Fink from BlackRock. And he said, I've said to him, you're Darth Vader. And Larry Fink said, well, it's not entirely untrue. that when you create a market that consumes things, as Mike Green says, you give me money, I buy stuff. It's going to be large and liquid. If you say I need cash, then I sell stuff, and that's what passive money does. Well, it's inhospitable to IPOs. IPOs are for a market of risk-taking fundamental capital with a long horizon. That's what we used to have. We have not had that market really since 2005, because 2005 is when Reg NMS was implemented, and it turned the stock market into a data network, a market-making system that pushed prices to the average. Well, who benefits from the prevalence of average prices? Passives do, because that's what they track. So now you got half the volume every day in the opening and closing auctions. That's not a great market for IPOs, where we have no idea how they're going to do, how those businesses are going to perform, and there's no data, and they just fall through the cracks. And so SpaceX is enormous, but it will be subject to the same, foibles that currently affect the market, which is that it's stuffed with passives, riven with arbitrage, and it's not a great place to form capital. The private equity market is. Other than that, everything's fine. I'm not pessimistic, but I'm very pragmatic about it. It's why I say, let's trade daily trading ideas. And when the model portfolios are working, we're in those things. We will deliver superior returns. And when both of those things are giving flashing warning signs, then we just wait. And I think they are right now.